Good afternoon, everyone. It is currently 1 o'clock, so let's get started. So first of all, if we could just do a quick audio check to make sure that you can hear me. You should have a chat box at the top, or actually, I don't know whether your menu is at the top or the bottom of the page, but anyway, either way, you should have a chat box. Can you just jump into that chat box and let me know with a quick yes or thumbs up or I can hear you, something like that, just to let me know that I am coming through to you. So if you go to the chat box and just let me know that you can hear me. Oh, no, we've got Q&A. So you might be doing it in the Q&A box instead. Okay. So if you don't have a chat box, you have a Q&A area, which is great because if you want to ask any questions, then please do so in the Q&A section. So you've already identified it. I can see loads of you have already identified it. If you've got any questions at all, put them in Q&A, because if you put them in Q&A, then that means I have to answer that question before I can see the next question. Now, what I might do is I might, look at your question as we're going through the presentation. And the presentation is about the real truth about the UK housing market and where to find opportunities within it. And if I think that that's a question that I should answer at the end, I might leave it till the end. So don't worry if I don't answer your question as soon as you ask it. I'll answer that question a little bit later. So thanks very much. First of all, thanks very much for joining me. 1 o'clock on forget which day it is now, let's say Wednesday. 1 o'clock on a Wednesday. So thanks for being here. So what we're going to look at is the real truth about the UK housing market and where to find opportunities within it. And I thought this would be a really good opportunity for a webinar because we get so much data these days. I am currently 43, just about to turn 44. And I remember, like, being a kid, you had one, maybe two sources of information, sources of data, and that's where you got your information from. And those two sources of data would probably align. However, now we collect, we collate, we store so much data that you can talk about one topic and you get lots and lots of different opinions as to the data itself, analyzing that data and what's going to come from the position that you're currently in. So I thought I'd give you our take on what the housing market is doing and where it's going to go, because we're involved in it, right? We're not like a media broadcaster who might be broadcasting or compiling this amount of data in order to get viewing figures, in order to get people to watch their news channel or read their blog or whatever. We are a developer. We are a property developer. We have been for the last 5 years within the banner of Sourced. We have been for a previous 10 years before that, and we are going to continue to be a property developer. So from our point of view, what are we reading into the data that's available? And what decisions are we then making based on that data? And where are we looking for opportunities? Now, that's one thing. Now, I realize that you might not be at the same level as we are in terms of the property developments that you're doing. So also, I wanted to put in how to find those opportunities. And if I was starting out now, what would I be doing to find those kind of opportunities that are available in the market and where the demand might not be quite so fierce as it is in other parts of the market? So without further ado, let's get cracking. So my name is Chris Kirkwood. I'm the franchise director here at Sourced. And in my time in business, I founded, run, and grown multiple businesses in different sectors. Basically, I started businesses. I created a huge amount of cash flow from those businesses, and I wanted to park that cash flow rather than just spending it. So when it came to investing, for me, there was only one opportunity. There was only one option, and that was property. I don't know whether it's sort of ingrained in us in school, but as soon as I had a pot of money by my side that I wanted to invest, it was obvious that I was going to go towards property because of the security and the returns that you can generate from property. So when I decided to go into property, I've been involved in all kinds of deals. The first deal that I bought was £67,500, but I've gone as low as £55,000 in some of the properties that I've bought. And I've been involved in developments up to £150 million GDV. So I've done, a very broad range of property development. I've done lots of different strategies myself as well. So in my own portfolio, I've done a number of different strategies, a number of different buying options, a number of different creative ways of solving problems. But now, as looking after the franchise side of the business, we have 185 franchisees. We have a huge amount of projects and deals going through, a huge amount of properties being bought and sold. And as the franchise director, I get involved in quite a lot of those deals, and more. I get more involved in the deals that are either of a higher net worth or are a little bit more creative. So, in terms of the overall kind of being able to execute on a property deal that is put in front of me, then me here at Sourced and my colleagues here at Sourced, there couldn't be anybody better placed. So when you look at Sourced and you look at our website, you might think, well, what the hell are you guys doing? You've got 4 different brands here. I don't know which one to click on. I don't know where to start. I don't know what your core focus is. So if you go to the website, you'll see 4 different brands. But essentially, we focus all of our attention and resource into 2 of those brands, and that is Sourced Franchise and Sourced Capital. So let me tell you a little bit more about them. Sourced Franchise, people come on board with us as franchisees. We offer them training, we offer them support, we give them property leads, and we give them access to the network of, like I said, 185 people. The training is both online and it's in person. The support is unlimited support, comprehensive support. The leads are property leads that have gone through our bespoke algorithms that we've designed here at Source. And the network, we put on lots of different networking events that allow people to collaborate together. The access to funding is then where Sourced Capital comes in, because we started our own in-house funding platform. They're a peer-to-peer funder, which is FCA regulated, and their terms as a funder is that they can lend up to 70% of the GDV. So now you think about a property project that you're doing. The value of the property today might be 100 grand. Now, normal lenders can lend you 70% of that current valuation, which might be 70 grand of that 100 grand. But Sourced Capital can lend you up to 70% of the end value. So say that project should be worth 200 grand once it's been refurbished. Sourced Capital could lend you up to 140 grand for that 100 grand initial valuation. So generally, as a general rule of thumb, our franchisees can borrow more money from Sourced Capital than they can from normal high street lenders, be that mortgage companies or bridges. Now, obviously, if you could borrow that, you can borrow based on the GDV, you can borrow the initial purchase price and also some, if not all, of the build costs. In terms of the amount of people that are interested in putting their money into this as a peer-to-peer platform, we raised 2 million quid in just under 24 hours earlier this year. So there's a huge amount of demand for it, because just like myself, people are interested in investing in property. And as a lender, Sourced Capital have been going for a number of years now, and they've got 100% repayment of capital and interest. So, really secure and robust system that they've set up at Sourced Capital, and that is exclusively available to the franchisees. So what are the other 2 brands that we look at on our website? So we've got Sourced Property. We created an app for our franchisees to sell their deals. Again, that's exclusive to our franchisees. So on this app, the franchisees can list properties, and anybody can download the app. Anybody can see the properties on that app, and if you're interested in that property, all the due diligence should be done for you there. You need to double check the due diligence yourself, but if you're happy with it, you can then purchase that property from one of our franchisees. We've also set up Sourced Auctions, again exclusive to our franchisees, where they can sell their deals. But also on the property side of the website, if you're interested in getting into property, you can see a huge amount of free content in there where you can learn more about property. So you might want to learn about assisted sales. You might want to learn about serviced accommodation. You might want to learn about HMOs. There's a lot of free content in there that allows you to boost your knowledge before you make that first purchase. And then additionally, we've got podcasts. So again, it's all about property. That's our passion. That's what we're interested in. So you can go and listen to our podcasts on there. I think they're released once every 2 weeks, and we have a huge amount of property professionals and insight and clever people that know a lot more about property than I do, coming on there and leading with value. Then finally, we've got developments, and developments is basically giving credibility to the kind of deals that we've done. So you can see some of our previous deals on there. And essentially, we've only put that part of the website on there so that when we make offers on new developments, we've got that to show the estate agents, because estate agents will always ask for, have you done something like this before? So we can give them evidence on our website of the kind of stuff that we've done before. So first of all, I will just want to get into a quick poll, and let me see if I can get this here. Right, okay. So here's the poll. You should be able to see that now. So property prices in 2023. What will happen to the property market in 2023? You've got a couple of answers. There. So you've got prices will increase more than 10%. Prices will increase less than 10%. It'll stay the same level as it is now. Or you've got it will decrease by less than 10%, or it'll decrease by more than 10%. So I've given you a couple of options because I want to know what the general mood is at the minute of how people are looking at property. So I'll just leave that up for a second. And this is really interesting because I'm going to make an assumption, right? So I apologize if I get this wrong, but this is my assumption that most people are going to read, or they're going to see, they're going to be influenced mainly by the media. So I really appreciate you all taking the time out to fill that in. Thank you very much. I think that's pretty much everyone that's filled it in now. That's amazing. So I'm gonna move on. And yeah, so I think that most people are influenced by the media. That is the main source that people are, because you don't need to go out of your way. You'll hear the news, you might check the BBC website because you want to know the football results, but you'll scroll past something on the main page that's talking about the housing market or properties. So you don't have to go out of your way to be sort of drip fed that information from the media. If you want to find out a little bit more, then you have to look into it in a bit more detail. You have to get into the nitty gritty. You have to look at specific websites that tell you, that you trust, that give you that kind of information. So the results of the poll were nobody thought that housing prices were going to go up, even though in the last month housing prices have gone up. Everybody thought that housing prices were the majority of people thought the housing prices were going to go down by less than 10%. And I totally understand why you guys have mainly voted for that. I'm just going to have a look at a couple of questions. So I think those questions I can leave till the end. So I'm just going to carry on. So the real truth about the UK housing market and finding opportunities within it, because this is really important. There's been a huge amount of information, right? Because the economy and the housing market are very closely linked. And there's been a lot of changes in the economy. Obviously, inflation we've been talking about for a long time. Every month we seem to be getting new information about inflation and how that's then driving the interest rates to go up. And then if interest rates are going up, it's affecting people's mortgages. And if it's affecting people's mortgages, it's affecting the amount of money they can spend from one month to the next. Now that coupled with increasing costs of living, for example, in utility prices, then that's putting even more of a squeeze on people's purses. So then that means it's probably less likely that people are moving out of their house and moving into a new house and taking on a bigger mortgage. So how is this all working together, and what results are we actually seeing in the housing market? So here is a really, really, really interesting chart that I found from looking at lots and lots of different websites, and this is by Zoopla, as you can see, because it's referenced on the top of the grid. Now, if you look, the black, everything in black is the comparison of where we are now in comparison to the average of 2017, 2019, so pre-pandemic levels. And pre-pandemic levels were, I'd say, stable, right? We were in a very, very sellers-dominated market back in 17 to 19, but it was relatively stable. Nobody was talking about the economy or the housing market that much back then because it was all sort of ticking along nicely. Now, the purple columns are a comparison of now to this time last year. Now, again, remember what I said previously about the media and the media wanting to drive traffic. They want to drive people towards them. They want to drive people to watch their newscast, or they want to drive people to their website. They want to drive people towards them so that they get the figures up, and therefore they potentially get more funding or can charge more for advertising or whatever their model is. So really the media are going to be reporting on where the most emotive figures are. Now let's have a look at the comparison of now compared to the stable market. The stable market back in 2017 to 2019. Well, it's actually fairly simple, right? It's actually fairly similar. All right, there's an 8% increase in demand currently. There's a 1% increase in number of sales agreed. So the number of sales going through is almost identical to pre-pandemic levels. The flow of new supply, so there are fewer properties that are coming onto the market now, and the stock of houses for sale is slightly lower. Well, that would make sense, right? That makes sense because the number of new houses coming onto the market is 4% lower. The demand is 8% up. And therefore, that means that there are fewer houses on the market because they're all being snapped up, exactly like it was in pre-pandemic levels. And if you remember to pre-pandemic levels, we had a ever so slightly increasing average property price in the UK. When it got into the pandemic and towards the end of the pandemic, the price of property absolutely skyrocketed because there were even fewer properties available. But now, in comparison to pre-pandemic, we were ever so slightly, we've got fewer properties that are on the market, but we've only got slightly more demand. So it's not that dissimilar. So when we were talking about this before the pandemic, nobody was talking about it in terms of, oh my God, things are changing so quickly. Property prices are going up. It's unsustainable. How are we gonna manage this? It can't keep on going like this. It was all very straightforward. For some reason, my screen wants to move on all the time. Apologies for that. However, when you look at this time, the current situation versus this time last year, demand is 51% lower. Number of sales agreed is 24% down, and the number of houses for sale is 61% up. Now, put all of that together. I would say that is more of an indicator as to how crazy the market was last year. Because last year, there was a huge amount of demand. And because of that huge amount of demand, we now see fewer sales going through compared to last year, which means that we've got 61% more properties on the market now in comparison to last year, because last year had a huge amount of demand. Now, if you were a media agency, what are you going to report on? So as a journalist, your prime function is to get people to look at your stuff. So what are you going to do? Are you going to say everything's pretty much the same as it was before COVID? Nothing to see here. Absolutely no reason to panic. We've sort of returned to a similar seller's market as we had previously. Is that the article that you're going to write? Or are you going to write that we've got 61% more houses on the market because there's a huge catastrophe? There's a huge issue with the housing market, and this is evidence of that. You're probably going to write the second article because that's going to get more viewers. That's going to get more people looking at what you're doing. So what you'll probably write is that demand has plummeted, that house sales are significantly lower, and that supply has dramatically increased. The amount of stock available is through the roof now. People cannot sell their houses. That's probably what you're going to write. But actually, we've returned to pre-pandemic levels, which sounds a lot less dramatic. Now, like I said, the property market is intrinsically linked to the overall economy. So where are we with the overall economy, and what is going to continue to happen? Because at the moment, I'd say that we're at a position where we've seen some fairly significant changes over the last 6 to 12 months. But where are we going forward from here? So inflation, which is the consumer prices index, which includes housing costs, is the one that I've used, was 8.8% in January. Now, 8.8% is still significantly higher than it should be, because the Bank of England is attempting to get inflation at or below 2%. But 8% is a lot better than it had been. We were up into the 10s and 11s% over the last few months. So 8.8% is showing that it is trending down and becoming much more controlled. Now, the interest rate is linked to inflation, obviously, and I'm sure you've seen that the interest rate has gone up to 4%. Now, the next meeting is on the 23rd of February. That's the meeting of the Bank of England where they decide whether they're going to put interest rates up or not. Now, as you can see from the article that goes with this, these two graphs that I've pinched, the top one is about inflation. The bottom one is about the tracking the interest rates. I've definitely put some kind of automatic moving on to the next slide thing on, and I apologize for that because I didn't want to do that. But interest rates at 4%. Interest rates go up in order to control inflation. Now, when they put interest rates up, it takes a little while for that to have an effect on the overall economy to then drive the interest, to then have an effect on the inflation percentage. So when they put the interest rates up to 4%, all they've seen since that point is that the inflation percentage, is coming down. Now, because of that, I think it's going to be a really tough call to say whether the interest rate is going to go up again on the 23rd of, sorry, that says February, it should be March, on the 23rd of March. Now, we have seen that they have a number of people that vote on whether the interest rate should go up or not. And I think it's been fairly unanimous over the past few months that they are going to put the interest rates up. I think the one in March, the meeting that they have in March, it's going to be either very, very tight whether the interest rate goes up, or it's going to get voted that the interest rate doesn't go up, because all they've seen is that inflation has been coming down because of the interest rates. Now, that means that mortgage interest rates are much more stable than they had been previously. And as you see at the bottom, that R word, the recession word, we have managed to avoid recession, which was announced over the last couple of months. Now, as soon as we managed to avoid recession, that had a huge impact on the property market, and specifically on the mortgages that were available to you. Because when it was predicted that we were going to go into a recession, lenders against property, so mortgage lenders, pulled a huge amount of deals away from the market. They didn't want their deals in the market. They wanted to de-risk what was available to new mortgage borrowers. And so they removed their most risky loans. And their most risky, what I mean by that is, like a 90% loan to value mortgage. They removed all that kind of stuff. They made it much harder for you to get a property without putting a significant amount of money in yourself. So let me give you an example of that. Standard property. So the standard value of a property, or the average value of a property in the UK, is just under £300,000. I think it's £289,000, something like that. Now, if you've got a loan to value mortgage of 80% and that rate is 2.49%, that means you would have to leave a deposit of £60,000, which means that your monthly mortgage cost would be just over £1,000. Now, if a mortgage company decides to pull that product, well, I don't want to offer an 80% mortgage anymore because that's too risky for me. I only want to offer a 60% mortgage. And obviously we saw that interest rates went up, which meant that the mortgage interest rates went up. Well, then now, in order to buy that same house on a 60% LTV mortgage, you're now paying double the deposit. And your monthly, even though you put in double of your own money, the monthly cost is higher than it was previously. So buying houses at that point is much more expensive. And mortgage companies put out these rates. They changed their rates to be on the lower sort of end of the scale because they were worried about the economy. Because if we go into a recession, it means that people are going to lose their jobs. It means that people are not going to get pay rises. And therefore, it's more likely that mortgages are going to go into default. Now, if a mortgage goes into default, that mortgage company would much rather that you had 120 grand invested into that property that you're going to lose rather than just 60 grand. So that's why mortgage companies were insistent that their products had to change, and they pulled so many of the high risk products. Now, if you look at, here's another interesting data point, which really this only scratches the surface of what you can read into it. Sales agreed compared to pre-pandemic years. So this is directly compared to the pre-pandemic years, like in the black bars of the previous chart. So in the Northeast, they've seen 30% more sales now than they had in pre-pandemic years. Scotland 16% up, London 4% up, Yorkshire and the Humber 2% up, Northwest 2% up, Wales 1% up, and the rest are down. So Southwest, Southeast, West Midlands, East Midlands, Eastern, which is like East Anglia, and the East Midlands. So they're down, but that overall leads to just a 1% change. So if you read into the 1% change, that gives you one data point, but you unpack that a little bit and you can see that predominantly the cheaper areas have sold a lot more. Now you unpack that even more, and it's not just the cheaper regions, the cheaper areas that have sold more, but it's the cheaper stock in the more expensive areas. So if you're in the Southeast, let's say, it's a traditionally very expensive area, the cheaper properties there have outsold the more expensive properties there in comparison to pre-pandemic levels. So overall, cheaper properties are much more appealing now than they had been pre-pandemic. Now, why is that? Well, that goes back to the mortgage issue, doesn't it? Because if you're buying a cheaper property, then you're going to need less money in your pocket in order to buy that property, even if it's only a 60% loan to value mortgage, even if the interest rate on that mortgage is 5.49%. It's still much more affordable for you. And that's a really interesting point, because that means that if you look at the overall situation of the market, first-time buyers are still buying. Now, usually when the property market slows down, it's because of first-time buyers. It's because first-time buyers are not buying, and therefore, if they're not buying at the very start of that chain, the chain doesn't get created because the first-time buyer isn't there. But actually, the situation that we're currently in, the first-time buyers are still buying. And why is that? Why are first-time buyers still buying, but other people are not buying? Well, if you think about it logically, first-time buyers are still buying properties because they haven't bought a property before. All right, it might be a 60% loan to value, and it might be 5.9% interest rate, but they've got nothing to compare it to. If they can afford it, they're still going to buy that property. So long as the affordability is there for them, they're still going to buy that property. And now that we've dodged the recession at the moment, then now that we've dodged the recession, it means that they've got more confidence in the market, they've got more confidence in their job, they've got more confidence in the overall performance of the property market in order to give them the boost to buy that property. So first-time buyers are still there. So if first-time buyers are still there, but we've only seen a 1% increase in property deals going through, who isn't there? Well, the people that aren't there are the people that already own properties. Because you imagine that the decision that you've made, and maybe you're in this position, right? You're looking at your own property, you're looking at your whether you're going to move house. And that's the situation that most people are in, don't forget. Most people are owner-occupiers, not necessarily investors. So most people are looking at their property and thinking, well, we're currently in a property where we've got X amount of equity, and we've got an interest rate, because we fixed when it was really, really low. We've got an interest rate of 1.49%, which costs us, I don't know, let's make something up here, £800 a month. Now that's where we currently are. And you know what? The house is nice. It's ours. We've moved in. We've been here for a few years. We've got it to a place that we enjoy living here. But really, we could move. So they look at moving, and they look on Rightmove, and they find a property, and it's slightly bigger. It's got an extra bedroom. It's got more outside space, whatever they're looking for. And then they go to the bottom of Rightmove and they look at the mortgage calculator, and they put in the amount of equity that they've got in their house, and they have to use all the equity that they've built up on their house. And then they look at the interest rate that's available, and all of a sudden, to buy just a slightly more expensive property, the killer is the interest rate that they would move on to would be 5.49% instead of 1.49%. And so that 800 quid goes up to 1,300, 1,400, 1,500 quid. It all of a sudden becomes a lot more expensive from an affordability point of view. And obviously the media are drip feeding them information, which is absolutely accurate. You know, the cost of living is going up for everybody. And therefore they look at that and they think, well, you know what, the house that we're in is okay for them. So that's the part of the market where they're not moving on. The chain that starts from the new buyer stops at the point where people cannot justify taking on a more expensive mortgage to upgrade into the next house up. And that's the part of the market that's stalling at the minute. And I'm not sure whether I didn't find any information about this from other people, but this is what we're seeing based on the information that we find. So therefore, if you take that into consideration, you take the economic situation into consideration, you take the housing market into consideration, where exactly are the opportunities right now? This is something that we've been talking about for at least, well, I think about a year now, but this is still absolutely accurate. And especially so when you consider that the kind of properties that you would want to turn into a HMO are probably those kind of properties that people would upgrade into. You know, a 4-bedroom, a 5-bedroom family home can really easily be converted to a HMO. So young professionals moving into that kind of HMO is a very desirable thing, and I'll explain why in just a second. But those houses are available on the market. There's an abundance of them. You see this type of house stay on the market for longer and longer and longer at the minute, because the demand for this kind of thing is just not there, because people don't want to upgrade into this type of house. So if the demand is lower, that means that for you, it's easier to negotiate a discount on this kind of property. And this is something that we teach our franchisees. This is something we reiterate to our franchisees all the time, that you've got to be aggressive with the way that you're purchasing property when you're negotiating with vendors, and find out about the vendor's situation. You know, you can easily get a lot of data from like Rightmove. You can see how long the property's been on the market for. So, you know, use that to your advantage. If it's been on the market for 6 months, then the way that I would enter into that discussion, that negotiation, would be, your property's been on the market for 6 months. It could quite easily be on the market for another 6 months. And after that, you might have to agree a big discount because it just isn't selling. Well, instead of waiting another 6 months, let's just agree a discount now, and let's move forward now, where you can put this money in your pocket rather than stalling and taking up more of your time. That's the kind of way that I would negotiate this kind of deal. So why young professionals? Why specifically young professionals going into HMOs? Well, we've seen a huge increase in the amount of young professionals looking at HMOs as a viable alternative to purchasing or renting their own flat or house, because it's cost effective, because the bills are fixed. So that gives them security over understanding what their monthly costs are going to be. So imagine it from their point of view. They could pay this 600 quid to live in a HMO, or 600 quid to rent a flat. But when you rent a flat, you've then got council tax and water and gas and electricity and service charge on top of that. But any one of those additional bills could go up and put more of a squeeze on your pocket. But you pay the 600 quid to live in a HMO and it's fixed. You know, you've got security of knowing that it's going to stay at that point. Now, I put young professionals HMOs because there's very different types of HMOs out there, isn't there? You could get HMOs that are student based, and they're, you know, if it's a comparison to the kind of HMO that I lived in when I was a student, a bit of a hole. But if you're targeting young professionals, you're going to be looking at really increasing the facility and the quality of that HMO. And so long as you do that and then you maintain that quality, then you've got a product where there is going to be a huge amount of demand, not only now, but for the foreseeable future. So one of the HMOs that we're building at the moment is a 24-bed HMO. It's got a library, it's got like a study and office room, it's got a gym, it's got a huge amount of communal space. It's very, very, very high end. And we're doing that, we're building that because we know that this is where the demand is. Now, 24-bed HMO, that's obviously not a normal family home that we've converted into that. We've converted a care home into the HMO. We've got planning permission for it. It's a project that's going ahead right now. But this is something that we're actually doing because this is where we see the increase in demand in this part of the market. So also looking at other properties that are not selling because people are not moving into them, you've got bungalows, and bungalows are absolutely standard because people tend to move out of bungalows and move into care. But then the new person that's going to buy that bungalow tends to be of an older age bracket. But those people that are of the older age bracket cannot make that decision to move into the bungalow, even if it's downsizing, but cannot make that decision to move into the bungalow because it's going to cost them so much more. So the tactic here and the tactic for the next one, because I'm going to let you know now, the property is not selling. It might not be a bungalow. It might be something that somebody's downsizing into. Both the same thing. They can't make that decision to move because it's going to be more expensive. So the tactic here would be something like buying the bungalow and seeing their way through until these people have to make a decision because their mortgage payments are about to go up, and therefore the demand will then rise in bungalows or rise in downsizing sort of opportunities. But these are two parts of the market where you go onto Rightmove, you can find bungalows, you see them on there, and you see how long they've been on there, and that length of time that properties have been on there, such as bungalows or properties that are getting downsized into, keeps on getting longer and longer and longer. And therefore, the opportunity for you is you can negotiate the purchase price to be lower because, again, these people are not. There's just no demand there, and therefore, if you're a viable, realistic buyer, then you can snap these properties up. So you might want a strategy where you're going to rent it out for a couple of years. Obviously, you need to do your due diligence to make sure that you're going to get your money, you're going to have your mortgage covered and maybe making a little bit of money on top of that. But you keep hold of it for 2 or 3 years. You sell it in 2 or 3 years' time when demand has reestablished itself, and you're selling it at a premium at that point. And that's where you're going to make your money in a couple of years' time. So that's for properties like bungalows, properties like downsizing properties. Now, where do you find these deals? If I was starting out again, I'd do exactly the same thing as when I originally started out, and I'd hammer the living daylights out of Rightmove. But I wouldn't, and I teach this, I tell this to my franchisees all the time. You should never find yourself just scrolling and scrolling and scrolling on Rightmove. It's all about systemization. You've got to systemize yourself. So when you're looking for HMOs, the way that I would look for HMOs would be I'd set it up so that I had a set search on there, which is for 3 bedrooms plus. I'd select detached or semi-detached or terrace properties. I'd select the minimum price because I don't want the smallest 3-bedroom properties. I want sort of mid-sized to large 3-bedroom properties plus. And then I'd set an alert. So that alert would send me an email every single day. And on that email, I would get a list of all the new properties that are listed that satisfy that search. And therefore, what I'll do is I'll look through that list of properties. I will already have done my due diligence on the area and how much income I could make from a HMO in that area. And I'd know what kind of level of property I'm looking for. So for a 3-bed, I'd be looking for, no more than 250 grand. For a 4-bed, I'd be looking for no more than 300 grand. For a 5-bed, I've been looking for no more than 450 grand. But again, I don't want the smallest ones. I don't want the cheapest ones, but that's the ceiling price. I would set that up, and then I would get that email and I would scan down that email and I'd say 3-bedroom, £240,000. I'd have a quick look into it. I'd see that the layout was good for being converted into a HMO. And then I would do my due diligence on that property to make sure that that property fits. You've got to use the systems that are available to you and then put your systems in the back end of that to do your due diligence to work out whether these properties work. Now, for those, we talk about this on my induction training that we do here at Sourced. And we talk about like the ceiling prices and the maximum prices you can go to and how to calculate that, how you can put little formulas together that help you identify the opportunities. Because you've got 2 things that you're looking out for in most property deals. First of all, you've got the finances. Secondly, you've got the overall structure and layout of the property. And you can do the finances really quickly. So that's your first level of due diligence done. If you know that you can buy a 4-bedroom house that you'll turn into a 5-bedroom house and it's going to be 280 grand, well, you know how much the bedrooms cost for a HMO in that area. You can put all of that together very, very quickly in a systemized way. The second thing that you need to do is look at the layout and the structure, and you can do that. It's going to take you a little bit more time, but you're only moving on to that section once you've already done the finance. So for bungalows, it's a slightly different approach. For bungalows, they tend to be built in the same kind of area. So what I would do is I would have my map view open in Rightmove, and I would draw around the areas in which I know bungalows are of a very high density. I'd select detached because bungalows tend to be detached, and then I would sort by date listed, because again, I want to see the properties that are on there that have been on there for a long period of time to give me the best chance of negotiating the property price down. And for the downsizer kind of properties, exactly the same kind of thing. You know, the people of a aging generation tend to live in similar kinds of areas. So I'd look at that downsizer kind of property and I'd do exactly the same search. So in terms of sourced, you know, I've mentioned a couple of things that we do for our franchisees. What exactly do I mean by franchisees, and what is involved in this? So people come on board with us and they pay us a franchise fee to join, and then they pay us a monthly fee. And for that, they get a huge amount of information, resources, training, support, leads, and access to funding. So basically, we're a one-stop shop for anything that they want to achieve in property, and whether they want to achieve cash flow or whether they want to achieve, you know, doing big property deals, we can help and support them through that system. So the support that we have here at Source, which I think is unique to the rest of the UK, is it's on demand. Every single one of our franchisees has a link into our support people, their calendar. So they can book in whenever they want to, whenever they want a meeting, whenever they want a chat, or they can just call them. The support team are there all the time. That is their sole function, to be at to help the franchisees become more successful. I mentioned induction training, and that's the only thing that we're insistent on. You need to come here for induction training, and then all of the other training and resources and online training or face-to-face training is completely down to you as to what you want to do and how it suits your direction and the way that you're moving forward. We also do joint ventures with our franchisees, and you can see some of those joint ventures on the development side of our website. And then we've got a tried and tested business model. We have franchisees that have done every kind of thing in property that you can think of, and have been incredibly successful at it. So let's think of something that's a bit creative, like assisted sales. We've actually got 2 assisted sales on the go right now, being executed by people in our network. And that's just assisted sales. The properties that are being just bought, the properties that are being traded, the joint ventures, the commercial conversions, the new builds, there's a huge amount of that throughout our network by people who have taken advantage of our training, taken advantage of our support, taken advantage of our funding, and are now reaping the benefits of that. So you've got access to peer-to-peer lending. We have over 180 franchisees across the UK, and you're a part of that network, part of that network who are all moving in the same direction. The next time that our network gets together is the 12th of May, I think, at the Source Summit. We invite all of our franchisees every quarter to come together for an event. And next event, we're having a party afterwards for all of our franchisees, to say, well done for the previous year. We'll provide entertainment, we'll provide food for them. We're, basically just giving everybody a pat on the back and saying, fantastic year, let's move on to the next one. In order to do that, we need to produce deal calculators and standardized systems to help our franchisees assess property deals as quickly as possible. And we also provide a CRM and a computer software package to allow them to store and move their property deals down the conveyancing route and keep everything in a very organized structure. Like I said, we have our Source Property app and we have auctions that's purely set up for our franchisees to enable them to sell deals, to build their cash flow if that's what they want to focus on. And our support team offer not only business planning, but also accountability and monthly accountability meetings to make sure that people are on track with what they're doing. We have leads, and obviously we're a big company. we have partners and affiliates across the UK who give our franchisees discounts for utilising different things within the property space, like discounts on service accommodation management, discounts on normal management, discounts on different tools, discounts on professional services, and that kind of thing. And to get hold of that, like I said, the fee to join £12,999 plus VAT, and it's £245 per month plus VAT as well. Oh, let me go back to the other poll. So I have another poll for you now. If I go to that one, let me just get this up for you. So here's the question. Do you want to be in property full time? You know, I'd really like to know, with the data that we put together, with the information that we provide, what are you trying to do? What are you trying to achieve? How can I tailor my presentations to you better next month and the month after and the month after? Are you trying to be in property full time, or is it something that you're just interested in from a side project point of view, or is it something that you want to do hands-free? Do you want to be involved in property but not have to put anything into it yourself? So if you can let me know, that would be terrific. I do like the picture of that property behind. It's a sort of grand designsy, that one, isn't it? But it's actually one of the grand designs things that I could really see myself living in. Okay, I'll end that there. Thank you very much for taking part in that poll. Let me just go back and move that across. I don't know whether you can see that. I might just be talking to myself. Now, one of the things that we do put on for people that are interested in being in property full time, and I can see that a lot of you are interested in being in property full time. If you wanted to, the franchise is a viable option for you. If you wanted to find out more, you can attend our next Discovery Day. Our next Discovery Day is on the 26th of April, and that's going to be in London. We're going to be down there for the full day, me and a few guys from HQ here in the north, and we're going to tell you a little bit more. We're going to go into a bit more detail about Source and some of the success stories that the franchisees have had. But really, we're just there to answer your questions. So we're going to be down there 26th of April. If you're interested in that, please feel free to scan that QR code and you can book yourself on there. Now, if you want to have a conversation before the 26th of April, which is quite a long time off, I'm going to give you some contact details at the end of this presentation, which you can have a look at instead. So how do our franchisees make the most of what we have available at Source? You've got an onboarding course, and once you've done the onboarding course, which is a series of videos before you come to induction training, you then have induction training that you can come to, or what we're insistent that you come to, because not only do we want to teach you our systems and processes and the way that we think about property, but also we want you to meet other franchisees and start that networking journey as well, where you're all collaborating together. The Sourced Summit is and the 90-day planning, which is part of the Sourced Summit. You need to make sure that you book yourself onto that. That's what we're having on the 12th of May, and then there's a party afterwards for our guys. You should set a goal-setting session with your support person, and that will help you identify the direction that you want to take your journey. And then you book and complete the training courses that are relevant to the goals that you've set yourself with your support person. You then jump onto the monthly accountability to make sure that you're on track, you're on target, you're focused, you're moving in the direction that you want to be, and then you're using your support person for deal review all the time. So you'll find deals, you send them across to your support person, and they can help you analyze those deals to identify whether they're a real opportunity or not. And then you've got ad hoc one-to-one support whenever you feel you need it. You might have done the training course, but you might have some questions about that strategy. You book yourself onto a one-to-one, and your support person is there to help you. Finally, the last poll, and this poll is just a simple one. Would you be interested in me sending you a Source brochure? Let me know, and I can either send it across to you or not. You will be getting a recording of this webinar, and you'll probably be getting the recording of this webinar tomorrow when our marketing team send it out. So it would be good to know whether you're interested or not. And I do see people still answering this question, so I'll just leave it up for a couple of minutes while you're getting through that. Okay, so regardless of whether you want the brochure or not, we're still going to send this out for you to have a look at. So you've got the recording so that you can have a look at the data and the stats and the stuff that we looked at and the opportunities that we see in the market going forward. I've ended that poll now. Thank you very much for taking part. And here are the QR codes for the two guys that you can arrange to have a conversation with if you're interested. Now, let me get onto the Q&A section now, because quite a few of you have asked some questions. So let me get into that. If you have got questions, this is the end of the presentation. All I'm going to do now is answer the questions that people have asked while I've been talking. So if you've got any questions, please put them into the Q&A section right now. Would you buy a property to live in yourself with a mortgage because of inflation? Yes, I would. That's fairly simple. I absolutely would do that. Now, would I think that question can go into a lot more. It can stress me a lot more, that question. Now, would I buy a property that was right at the top of my affordability because of inflation? No, I wouldn't do that at the moment. I don't think that's sensible, because as you've identified from the position of inflation at the moment, costs are just going to keep on going up, because we're never going to go from 8.8% down to 1% from 1 month to the next. So would I make that decision to stretch my budget as much as I could? No, I wouldn't. But would I still buy a property to live in myself? Yes, I would. Just get rid of that question and move on to the next one. With the potential lending up to 70%, is there a chance, depending on the deal, someone could borrow enough money to buy, renovate and refinance without actually putting money in themselves using Source? Chris, I think it's really important that you identify that there are costs to buying a property that are not involved in the property purchase and the refurbishment costs. So you've still got stamp duty to pay, which is never going to get funded by a lender. You've still got some upfront costs to pay. So those costs, you'd still need to satisfy yourself. The purchase price and the refurbishment costs, can you get that from Source Capital without having to contribute to either one of those costs? Yes, absolutely. Franchisees do it all the time. Yes, that is an absolute resounding yes. And we've got plenty of evidence to back that up. The additional costs that you have around that property, can you get them funded? No, you can't. Now, those costs are very, very low on a normal property purchase in relation to the amount of deposit that you'll normally need to put into a property. So actually, what Source Capital is doing is it's dramatically reducing the amount of money that you need to put into the property deal. So that still reduces that amount of money. And like I said, because of the JVs that we do JVs with franchisees. So if you come to us with a property project that works, where the profit level is over 350 grand, we could JV with you. So you still get access to that profit margin at the end of the project, but we would cover all the costs. So yes, we would use Source Capital for the purchase price and the refurb costs, but the stamp duty, the surveyor's costs, the architect, the planning, potentially, we would cover all of those costs. So if you've got a small amount of capital by your side and you want to get into purchasing property, Source Capital is a terrific option for you. If you've got no capital by your side, but you want to get into the property world, then JVing with Sourced HQ is a terrific option for you. Or one of the other things that we do with our franchisees is we show them the options that they have. So they can look at building their cash flow, building their pot of money by selling deals, for example, or other ways of doing it, using investors' money. We show them lots of different strategies so they can build their pot of money, which then enables them to buy their first house as an investment, or enables them to buy a big project as an investment. So we've got lots of different ways that we can satisfy that situation. And what would happen is you would come on board with us and you would have that conversation with your support person, and you'd come up with a strategy for what exactly you're going to do. Because your strategy isn't just based on how much money you've got by your side. It's about you. It's about what you're good at. It's about your skill set. It's about making sure we're maximizing everything that you have available in order to build your property business. Even more questions have come through now. Hi, would you recommend off-plan opportunities, say completing Q4 2024, so that the mortgage interest may be relatively lower at the time? Yeah, potentially. I mean, an off-plan opportunity that's completing in Q4 2024, there's additional risks that come with off-plan. which you need to mitigate. And those risks are the viability of the building company that's putting that together. So you need to do your homework not only on the viability of the project, the property, and whether that's going to make you money over the long term, but you also need to do your analysis over the company itself and whether the company is still going to be going in Q4 2024 or whether the company potentially could have gone bust, because that's the additional risk that you need to mitigate for. Now, if that company's been trading since 1980, or if that company's been trading for 6 or 7 years, then you've got a relatively secure situation there. But you still need to look on Companies House and look through their previous accounts and see that they've got plenty of money on hand in case things get squeezed and things get tight. So you need to do additional due diligence on any new build opportunity. But in terms of deferring the first time that you need to make that mortgage payment, it's a really good idea. Like I said, with the bungalow and the downsizing property, if you can rent that out, if you can buy that kind of property and rent that out and still cover the mortgage, then that may be a better way to secure future capital uplift as the demand increases when that part of the market returns to a more stable level. I hope that makes sense. Do you offer also support contacts for finding and managing builder connections? Yes, absolutely. That's something that the support person will absolutely help with, if not get involved with in speaking to builders. Is there another date? Because it says the sale for the tickets has ended. Oh, let me look into that. If you keep hold of that web address, there should still be tickets available for that one on the 26th of April. So I'll have a look into that. Just bear with me. We'll send out an update on that on the email that we send out tomorrow with the link to the recording. Bookings are full for the 26th. Yeah, I see that. I'll deal with that. What research do you help with for professional HMOs? Well, here we go. What research do you help with for professional HMOs? Well, it's all about demand. So you're absolutely right. One area might not have any demand whatsoever for professional HMOs, and one area might have a huge amount of demand for professional HMOs. So how do you identify that area? Well, first of all, you'd go to spare room, because that's the epicenter for all HMO data. So you'd go to spare room and you would look at the number of properties available versus the number of renters looking. But that's only the start. You would then go even deeper and you would find the kind of rooms that you're going to offer, and you would have a look at those. You would save those rooms and you would keep a note of those rooms, and you would keep a chart of how long those rooms have been on the market for and when those rooms disappear from the market, because the only reason that somebody's going to take a room off spare room is when it's rented. And believe me, I've been a HMO landlord. As soon as it's rented, I take it off spare room because I don't want any more inquiries, because I just don't want my inbox filling up. So I take that off spare room straight away. Now, if you're then compiling all of that data, you will see the types of rooms available and the types of tenants that they're targeting and the speed at which that room disappears. Now, you compile that data for 1 or 2 months, and you've all of a sudden got a very, very, very clear picture as to where the demand is for that kind of property. And that's what will drive where you invest into young professional HMOs. Hope that helps. What's the best cash flow strategy in property without having to put in too much investment? I think if you were listening to another webinar from somebody else, they'd say to you a strategy. But I cannot answer that question based on the way that you've asked that question, because the way that you've asked that question doesn't tell me anything about you. And the best cash flow strategy is not only determined by how much cash you've got, which might not be very much because you're looking at cash flow. It's about you and your character and your skill set. Because we've got some people who sell deals, and we've got other people who have tried to sell deals. And maybe against our judgment or against our recommendation, they've tried to sell deals and they've failed at it because they're just not set up to be that kind of salesman. Now, they've gone on to be very successful in building a rent-to-rent portfolio or building a HMO portfolio or commercial conversions or JVs. But at selling deals, they haven't done a great job because they have to talk to investors and they have to sell deals to investors. We've got other people in the network who are making 30, 40, 50,000 pounds per month selling deals because they are natural salespeople. So I can't answer that question without getting to know you a little bit more, I'm afraid. Can you buy jointly with a first-time buyer to live in and get any benefits, or do we both need to be the first-time buyers to get any benefits? So that is more of a question for the Help to Buy, I believe, because they're the benefits that you could get from Help to Buy, and the Help to Buy scheme, to my best knowledge, has been ended now, so I don't think you can get any benefits from that. Aside from that, I'm not aware of any benefits that first-time buyers get. So, well, apart from lower stamp duty than an investment buyer. So, yeah, and I think for lower stamp duty for an investment buyer, you would still pay the higher stamp duty rate. Although stamp duty is one of those dark arts where you can use a specialist, and a specialist will come up with a way that you maybe don't have to pay the full investment rate of stamp duty. But apart from that, not aware of any other benefits, so you'll have to inform me. Would you buy to live in without a mortgage, or would you take a mortgage in this climate to keep money free to buy more? What sort of mortgage would you take out? You know what? I can't answer that question because I haven't looked at it myself and my situation. Now we look at investment mortgages all the time. We're refinancing a couple of projects at the minute, so I'm aware of investment mortgages. In terms of what I would do with my money, I absolutely would not at the moment tie all my money up into my own property. I would keep something liquid because there is still a great opportunity to buy discounted property at the moment, and the ones that I've highlighted, I would still, and I am still, building a HMO portfolio. I want to do that at the minute because A, I can buy those properties cheaper than I normally can, and B, there's a huge amount of demand. So I would not be tying all my money up into my own house because there's great investment opportunity out there. Now, what kind of mortgage I would take, I can't answer because I'm not aware of what's available today. I haven't been able to attend due to conflict. Would you be able to share these slides? We'll share the video tomorrow. But thank you for the message. What do you need to have to become a cleaning management company within property? And how do you set yourself up within a property portal to check in customers, etc.? That's not really a question for this webinar, so I'm going to leave that question. Thank you, Don, for confirming that that makes sense. What financial knowledge do you require to know each aspect within property? That's a massive question. The financial knowledge, as in the due diligence that you need to do, is pretty extensive. I mean, you need to double check every single figure that you put together in order to test whether a property project works. We have a very, very extensive spreadsheet that we use for our franchisees, which is now getting turned into a web-based deal calculator. Maybe one day I'll do a webinar about that deal calculator and the amount of due diligence that we go into in order to show you. So keep an eye out on future webinars, and I'll talk to the marketing team when I come off this meeting and see if I can get that arranged. Great presentation. Well, thank you very much. What are your thoughts on an investment strategy on holiday lets and larger holiday lets? So one of the things, you know, I just looked into this morning was the planning permission that's needed in Scotland in order to run a holiday let. So recently, Edinburgh has put in a requirement where if you're going to run, recently Edinburgh has announced that from August this year, there is going to be a requirement that if you want to run a short-term holiday let, you need to have planning permission in order to run that short-term holiday let. And you only pre-qualify if you've been running a holiday let and can prove it for 10 years or more. Now, that's happening in Edinburgh because of things like the Fringe. So the Edinburgh Fringe has become a very expensive place to go because people are charging a huge amount of money for service accommodation during the Fringe Festival. Now, to be perfectly honest, I see that rolling out across lots of other places. And I actually put a post in our intranet this morning where only the franchisees have access to it, and said, my prediction is that holiday lets or short-term lets are going to get their own use class code. So for those of you that are a bit techie about property, a normal family home is use class C3. A HMO is use class C4. And I predicted this morning that I think holiday lets are going to get use class C5. Now, if that happens, there's going to be a lot more restrictions on holiday lets, and that is going to be completely controlled by the council, by councils, whether they want holiday lets in those areas. And if the requirement is that you've been running a holiday let for more than 10 years, you pre-qualify for that C5 level, that's all of a sudden going to discount thousands and thousands and thousands of holiday lets across the country. And that's going to put a lot of people in a bit of bother. You're going to see a lot of properties that are listed back onto the market to sell because they're just not a viable option as a normal rental property. So for serviced accommodation, I've been saying this for the last 18 months. I see something big happening in the regulation of serviced accommodation because the way that it's currently regulated is not good enough. So I think by all means, buy a property for serviced accommodation, but have a very solid plan B. That's what I would say about serviced accommodation at the minute. And that's the perspective we have on property, right? We're not only telling people, oh yeah, serviced accommodation is brilliant. Look at the data over the last 5 years. We're looking at what's going to happen in the future as well. And that's what we advise our franchisees on, because when they sign up with us, they sign up for 5 years. And so we have a business relationship with the franchisees. We're interested in them being successful for 5 years, not just right now. So because of our perspective, that's what I would say about serviced accommodation. It's not something that I would currently throw my heart and soul into. How can you help raise EPC ratings with upcoming legislation for buy-to-let landlords? Again, Harry, that's not really for this webinar, but we have a EPC assessor who is very happy to talk to people about that kind of thing as one of our franchisees. I could always put you in touch with them. If you send an email to franchise@source.co that's on the left-hand side here, and I'll send you his details. Do you have discounted deals, e.g. below a RICS valuation currently on HMOs, vanilla buy-to-lets? You mean on the app, Harry, I assume? If so, I couldn't tell you because I'm not sure exactly which properties are currently on the app, but you can very easily go in there and you can filter down to look at HMOs or potential HMOs, and then you can ask that question directly to the person that's selling that deal in the app. You can message them directly. So by all means, go ahead and do that. I'm subscribed to getting deals through Source. However, I have found too many times that the numbers don't make sense or add up. I'm an accountant by profession. Do you teach your franchisees how to work out the financials without errors? This is not a complaint, but a concern that a lot of people send deals to my inbox without making sense that the numbers add up or stack up. Well, to be quite honest on, a lot of putting deals together or putting figures together is a little bit subjective. So instead of saying, to me, your numbers don't work, what I would do is engage with that person and ask them to justify where they're getting the numbers from. And if you can do that, then and they might present data to you that you are not currently aware of, then that might be a different way of looking at that property. So I would always, whether I'm buying a deal from one of my guys or whether I'm buying a deal from anybody else out there in the market, always ask them to justify their numbers. And I would compare their justifications with my justifications. And if I'm happy with my justifications, I go with mine. But they might have seen something, or they might be looking at something, or they might have a quote for something from somebody that I hadn't even spoken to. So they might be able to secure it. So I'd definitely do this. Would you suggest buying properties from auctions? Well, we have our own auctions company. So absolutely, yes, I would. Don, yeah, great. And you know what? You've got franchise@source.co there. And if you're not getting the answers that you're looking for, by all means, let us know and we'll chase that up for you, Don, because we want to make sure that you guys are getting the service that you require from our franchisees and from the app. Do you pay interest in the peer-to-peer lending group? So if you put your money into the peer-to-peer platform, into Source Capital, then absolutely you will get a rate of interest in return. And historically, that rate of interest has been just under 12%. I think it's 11.3%, something like that. So a really solid rate of interest there. So yes, absolutely. If that's something that you're interested in being hands-free, go and have a look at Source Capital for that kind of thing. Right, that was a lot of questions. I think I've answered all of them now, so I really appreciate. I can see that pretty much 100% of you stayed on right the way till the end. So I really appreciate your time. Thank you for spending this Wednesday afternoon with me. We'll call it a day there after just over an hour. I hope it's been valuable to you. We'll send out the presentation tomorrow, so you can have another look through it. But thanks very much, and have a great Wednesday afternoon.